Welcome back to Investing Talk podcast. Today, we're taking a close look at a company really shaking things up in its sector, Terawulf. And the big question we're trying to answer for you is, well, with everything changing so fast, is WULF a good buy right now? Before we really get into it, though, if you like what we do here, please go ahead and hit that like button, subscribe, maybe drop us a comment. And yeah, definitely let us know in the comments if there's a specific company you'd like us to analyze next time.
That's right. And just to frame this properly, we're assessing Terawulf's investment case, looking at their latest financials, market analysis, all as of October 14, 2025. And the real focus here, like you said, isn't just their Bitcoin mining past. It's this major shift, this foundational move into digital infrastructure and, high-performance computing.
Okay, let's start unpacking that. Foundational shift starts with the numbers, right? And the headline here seems to be just, wow, explosive growth on the top line. Fiscal year 2024, Terawulf reported revenue of $140.05 million. That's
what?
102.3% increase from 2023. I mean, you just don't see that kind of triple-digit growth very often, especially not in more established areas.
Yeah, it's seriously impressive. And what's really fascinating, I think, is how they manage that growth while also sort of tightening things up operationally. Now, they did still report a net loss, $72.42 million for 2024.
Okay.
But, and this is important, they actually shrank that loss year over year. Just slightly, 1.37%.
Right.
And maybe even more telling is the gross margin. It's holding strong at 43.8%.
Wow.
That high margin points to, well, pretty solid operational efficiency. It suggests this new model running these high-demand compute centers, it's fundamentally maybe sounder than just pure mining.
So let's zero in on that pivot then. We used to talk hash rates. Now it's megawatts of compute. Why is this move, this transition from being just a digital asset miner to HPC colocation? Why is that so important? Why take on the hassle of data centers?
Yeah, it really boils down to predictability and stability.
Yeah.
Moving away from, let's say, volatile commodity revenue towards contracted infrastructure income, pure Bitcoin mining, as you know, the revenue can swing wildly day to day with the coin's price.
Sure.
This new model, though, providing AI HPC colocation, that means long-term contracts, deals with major companies needing guaranteed power, guaranteed space for their power-hungry AI models. So this transition, it locks in future revenue streams, makes them more stable, and it gives Terawulf potentially a really valuable first-mover advantage in this space.
Okay, first mover is interesting. What gives them that edge specifically? I mean, the data center space feels pretty crowded already. Why Terawulf?
Good question. It seems to be about two key things: location and power source. They've strategically built up massive data center capacity, primarily in New York and Pennsylvania. And these aren't just any data centers. They're engineered for ultra-high density computing.
Right.
And crucially, they have access, scalable access, to low-cost power. We're talking nuclear and renewables. That power profile, that's incredibly attractive, maybe even essential for the hyperscalers and the big AI players. It makes their setup quite hard to replicate quickly. So, yeah, right resources, right place, right time.
And it looks like the market is buying into that story. We're seeing external validation, right? Lots of bullish analyst upgrades recently. They're all pointing to accelerating AI adoption as the key driver here. I saw Clear Street raise its target to $16, and Roth Capital, they put out a pretty aggressive $21.50 target. That feels like strong confirmation that the street believes the strategy's working.
Absolutely.
Yeah.
But, analyst reports are one thing. You need the actual capital to make these big expansion plans happen. So let's maybe shift focus to the balance sheet, their financial strength. Right now, for immediate needs, they seem okay. As of June 30th, 2025, the company had around $90 million combined in cash equivalents, and Bitcoin reserves. That gives them some breathing room, some operational flexibility.
90 million is good breathing room, but for the kind of expansion they're talking about, that's not nearly enough, is it? They announced this huge proposed capital raise, $3.2 billion in senior secured notes due 2030. Now, for listeners maybe not steeped in corporate finance every day, could you break down what senior secured notes are, and why is management picking this path instead of, say, traditional bank loans or issuing more stock? What does that signal?
All right, that's a really critical point. It speaks volumes about management's thinking.
Yeah.
So senior secured notes, think of them like corporate bonds, but they're backed by specific assets. Collateralized. In this case, likely the data centers themselves. This makes them safer for the bond buyers, which usually means Terawulf gets a lower interest rate compared to unsecured debt. But the key takeaway for you, the listener, is why they chose debt over equity right now. By issuing debt instead of new shares, They avoid diluting existing shareholders.
Ah, right. Dilution.
Exactly. It's a very shareholder-friendly approach if it works. Management is basically signaling huge confidence. They believe this New York expansion will generate cash flow fast enough to cover the debt payments without having to sell off pieces of the company through stock offerings.
Okay, confidence is great, but $3.2 billion, that's a massive amount of debt to take on. Doesn't that inherently create significant risk? Like execution risk. What if the New York build-out gets delayed or interest rates spike? Are they potentially biting off more than they can chew here?
That is absolutely the central risk, no question, and we definitely need to circle back to that. But for now, it seems they're trying to mitigate that risk partly through strong partnerships. Having big financial names like Morgan Stanley involved lends credibility to the financing itself.
Sure.
And critically, look at their relationships with tech giants. Like Google, it seems to be deepening. If Google isn't just a potential customer, but maybe involved in technical partnerships, that's a huge stamp of approval. It makes lenders feel a lot more comfortable.
Okay, so the picture emerging is a fundamental business shift toward scalable AI infrastructure, funded by debt rather than equity to protect shareholders, and validated by some serious institutional players and tech partnerships. All right, let's see how these fundamentals are playing out in the market. Taking a look at the technicals. WLF closed at $15.59 yesterday, October 14th, 2025. And year to date, wow, it's up 184.7%. Quite a run.
The momentum is definitely there, yeah. But that price needs context. If you look at the charts, the probable trading range maybe for the next 3 months or so looks like it's somewhere between $13.50 on the low end and maybe $18.50 on the high end. Key resistance is basically right where it closed, that 52-week high around $15.60.
Okay.
And below that, your main technical support level is probably the 50-day moving average, which is currently sitting around $9.70.
And the fact that the stock is trading so far above both its 50-day moving average at $9.70 and its 200-day way down at $5.54, that pretty much confirms a very strong, sustained uptrend, doesn't it?
Oh, absolutely. From a long-term trend perspective, it looks very healthy. But,
Yeah.
and this is the crucial bit of caution we need to inject here, given that huge recent run-up. The Relative Strength Index, the RSI, it's been flashing pretty high lately, got up towards 81.4 recently.
Right.
Now, for anyone not glued to charts, that basically means the stock might be technically overbought in the very short term. There's a real possibility of tactical pullback, a breather. That said, volatility has actually been pretty moderate, around 11.3%. That suggests the buying hasn't just been wild speculation. It seems like more considered healthy accumulation, but still, the overbought signal is there.
Okay, let's pivot then to what's driving the stock right now. The immediate catalysts. We've seen some really important developments just in the past month or so that seem to be cementing this future direction. Obviously announcing that massive $3.2 billion note offering. That's huge news. And then there was that special meeting of stockholders on September 30th. They approved changes to the company charter, right? Basically making the shift away from just mining official company policy, tying the mission firmly to digital infrastructure.
Yeah, exactly. And don't overlook the expanded agreement with FluidStack. That was for 160 megawatts of data center capacity.
Right, I saw that.
That's significant because it gives much better visibility into future revenue. It shows there's real immediate demand for the infrastructure they're building out. So all these recent events kind of set the stage for the next, say, 3 months. And during that time, I think stock movement will hinge on a few critical dates and news items.
Okay, so what are those key dates or events we should be watching closely? What should listeners circle on their calendars?
All right, top of the list has to be the Q3 2025 earnings release. That's scheduled for November 11th. Market expectations are definitely high. People will be looking for proof of continued revenue growth and, importantly, margin expansion. They want to see that this pivot is actually boosting profitability.
Makes sense.
Second, watch for any news, and it could come any day really, on the actual progress of the data center expansions, particularly client signings. Naming big clients for those New York and Pennsylvania facilities, that would be a major catalyst.
Yeah, definitely.
And finally, a bit further out, keep an eye on the institutional 13F filings. Those are due around December 15th. They'll show us whether the big money managers, the institutions, were adding to their positions or maybe taking profits during this recent run-up in strategic shift.
Okay, we've laid out a pretty compelling, strongly bullish case here based on this fundamental transformation. But we always need to balance the narrative. Let's talk risks. If you had to pinpoint the main company-specific dangers that could derail this whole growth story, what would they be?
Well, the biggest one is probably what you touched on earlier, execution. pure and simple. They're taking on a massive, incredibly expensive construction and build-out project. If they fail to bring these big AI data centers online profitably and on time, well, that would really put a damper on the stock.
Right. Delays, cost overruns.
Exactly. And tied directly to that is the second major risk, leverage. The debt load from that $3.2 billion note offering is substantial. They absolutely need those new facilities to start generating strong cash flow quickly to service that debt comfortably. Any significant delays could create pressure. And finally, even with this diversification into HPC, they haven't completely eliminated their exposure to Bitcoin's price. A sharp downturn in crypto markets could still impact their short-term liquidity or sentiment around the stock. It's less of a factor than before, but it's not zero.
And beyond the known risks and confirmed news, is there any speculative buzz? Any rumors floating around that could significantly move the needle if they turned out to be true?
Yeah, there are a couple of things you hear whispers about, mainly in analyst notes or on social media forums. High impact, but definitely unconfirmed. One is the idea of that strategic relationship with Google deepening even further, maybe moving beyond just a customer-supplier dynamic towards something bigger, like an equity stake or a more integrated long-term operational partnership. That would be huge validation.
Wow. Okay.
And the other persistent rumor, given their unique assets especially, that low-cost green power access is M&A talk. Speculation that Terawulf could become a takeover target for one of the larger cloud providers or maybe a hyperscale data center operator looking to quickly acquire that kind of power advantage capacity.
All right. So pulling this all together, what's the bottom line for you, the listener? We've looked at the core business shift, the financials, the technicals, the catalysts, the risks. The analyst consensus seems clear. 8 to 10 analysts covering it rated a strong buy. Targets are mostly clustered between, say, $13 and that high $21.50 mark. Based on everything we've discussed, the growth, the strategy, our internal take here is a strong 9 out of 10. That puts it firmly in the bullish camp for us.
Yeah, I agree. And I think it presents an interesting case for potentially two types of investors, really. For someone with a shorter time frame, a tactical trader, those upcoming catalysts, especially the Q3 earnings in November, look like significant potential drivers for upside. But maybe more importantly, for the long-term investor, Terawulf seems really well positioned to ride that huge multi-year wave of growth in digital infrastructure and AI compute demand. It feels like a secular trend play.
Okay, so let's leave you with a final thought to chew on. We have this strong fundamental story, this bullish outlook, right? But we also noted the stock has had a massive run already, and those technical indicators are flashing overbought near that $15.60 resistance level. So the question is, how do you weigh the potential immediate upside from those Q3 earnings, which are just around the corner, against the possibility of getting a better entry point, maybe waiting for a short-term healthy pullback towards that $13.50 support level before committing capital to this potentially powerful long-term growth story? It's that classic dilemma, isn't it? Chase the momentum and the catalyst, or be patient and try to maximize your entry price. Something to consider.